If you look at the S&P, yes, it's almost 10% since the election, but you say 2.5% growth is more feasible than 4%. What's the market pricing in?
I think that the market is not pricing in that much more growth if we look at like expectations, because the other thing which is playing in the market currently is the prospect of a corporate tax cut. That's really what sort of has got people to revise up their earnings estimates. So I don't think there's been that dramatic an upward revision of economic growth since the election. Yes, possibly some. But if you look at the consensus forecast, people aren't expecting much more than 2.5% growth for this year or for next year. But I'd say that the big thing which has driven the market up also is the expectation that you're going to get a big corporate tax cut. That really is what's sort of driving the market a lot as well.
And to that tension, I mean, I go to energy companies because on the one hand, it was pricing in repatriation, it was pricing in a lower corporate tax and a pro-energy policy of a Trump administration. The reality of earnings is that it's still based on an oil price. So you have the fundamentals, which did not hold up, and you've seen those big oil stocks get hit, and then you have the hope. Where should investors be positioned between those two?
Well, I mean, I think that if you look at the history of what's happened to oil bull markets, which is the fact that typically after you end up getting a crash in oil prices, the price of oil tends to trade in a very wide range for a long period of time to come. So my best bet is that the price of oil is stuck in a range of between 30 to 60 for the foreseeable future. And now we're getting to the upside of that range. So as we get to the upside of that range, I'd be wary of investing in like energy stocks, just because I feel that that's not the time to do it. At $30 is a better time. But the base case is that the price of oil today is sort of trading in line with its very long-term historical average. I think this is the perspective lost on many people, which is the price of oil seems to have come off a lot from the highs of 140, but that was such an abnormal high. If you look at the 100-year history of oil prices, in inflation-adjusted terms today, the price of oil is not much higher than where it has been over the last 100 years, or since oil prices were deregulated back in 1973. So I think a range of 30 to 60, but as we get to the top end of that range, that's possibly not the best time to be investing in energy stocks.
Ruchir, if growth is the goal of this new administration, how important is it that they structure that corporate tax credit in a way to encourage capital investment rather than just give them cash?
Yeah, I think it's very hard to engineer the exact details, etc. But the really controversial proposal, which nobody knows what to do, and the market certainly has not priced it in, has to do with the border adjustability tax. So I think that's where the attention will turn to eventually. But I think that people's expectations is that the likelihood of that getting done is completely unknown, 50-50. So no one's priced any of that in. But that is has the impact of having a major sort of impact on the internals of the market. But so that's what I'm keeping really an eye out on. But it doesn't seem going to get much clarity on that until possibly the mid of this year. So
clarity on whether it happens or its nature.
I think both, because I mean, it's the same thing really, that whether it even happens, I think it's a 50-50 thing. I'm not sure it can happen because it's such a complicated tax that you're trying to put out there. But that has a major sort of impact on the internals of the market, and which has just not been priced in. But a corporate tax cut, I'd say that's about 70-80% priced in.